Portfolio Builder members, today is November 26th and we're trading the emerging markets, but I wanted to quickly take a look at our open positions in the SPY, up $969 just from yesterday's trade alert. And our trade alert on the TLT from last Thursday is now up $3,800. So we've officially hit a profit for November, and if we can close that profit out, we will have generated profits for our members in 11 of the past 12 months. And what's more important about delivering profit is not delivering volatility. For you to achieve a return in the last 12 months in the stock market, you've had to hold on to 8% volatility twice in 2019, in August and May. Plus, from October through December of last year, you had to hang on to a 20% plus drawdown in your account. So that's not very good risk to reward. You're risking at least $1 to make $1. If you look at our returns, we've generated 15.26% while risking 1%. So that's more like risking $1 to make $15. So if you're watching this, and you've got a lot of capital, you've had a good run in the equity market, you got to be asking yourself, do you feel lucky or is it time to start playing it safe? Because as you're going to see, our strategy works extremely well in periods of volatility and chaos, which I do think we have in the cards going into the 2020 election. Okay, so let's take a look at today's trade alert. Current trade alert is to close out the emerging markets ETF position and roll it over into next week. We're not seeing emerging markets really climb like the SPY, and to me this is indicating that people investing in China are skeptical that a trade deal will actually be accomplished, or that their fundamentals are just degrading at such a rapid rate that they're really in some trouble. And in our boot camp, we are going to be covering a once-in-a-lifetime opportunity to short the Chinese currency CNH for massive profits. So for those of you who are in the boot camp, can't wait to present that to you in about 2 hours. But the big picture is they have printed some $20 trillion worth of the yuan and declared it's worth 21 trillion USD, but they don't let anybody exchange the money. So it's a big house of cards, a massive housing bubble. And so the only thing that would really push emerging markets higher is a phase one trade deal and China actually opening up their economy for outside investment. They desperately need investment, and so they are incentivized to try to come to a deal with the US. So we'll see how that plays out, but let's just take a look at the trade alert today. Scroll down. This is all in your email, of course. First part of the trade is to buy to close the 44 call and sell to close the 43 put. That'll get you out of last week's trade. We're going to play it safe this week. We're doing the 43.50 call, which we're selling for a credit of 19 cents. And we're using that to finance downside protection for the 42.50 put. So if this trade deal explodes, doesn't come to any terms, TLT, GDX rocket higher, and this 42.50 put option kicks in on emerging markets. So we'll get no less than 42.50 a share, and we finance this protection for free by selling the call option. Now, if the market does go higher, which it wants to do because there's so much money sloshing around from central banks lowering interest rates, buying up government debt, the banks have pretty fresh balance sheets now compared to just a few months ago. And so we can potentially generate a $50 profit or just over 1% return week over week on this trade setup. So we have a 1-to-1 risk to reward ratio. And again, I would love for the trade war to implode, for stocks to tank, because we have tight put options on the SPY and emerging markets. And then we have all the room in the world for GDX and TLT to go higher and generate substantial profits. So that's the game plan right now. Now, on the other hand, if the phase one deal does get signed, again, we also have tight put options underneath GDX and TLT and decent amount of room to profit from equity prices. But as you've noticed, we've made a lot of money on the SPY, predicting it would swing up to 315 on hopes of a trade deal. We got to just under 315. I was about $1 off on my prediction, and I think with a phase 1 trade deal, it can go substantially higher. Okay, so let's take a quick look at how our program works and then jump into the top news. Daily income trade alerts at noon Eastern. Our trade allocation per $75,000 invested is 54% in equities, 38% in bonds, 8% in gold. But we're not just buying and holding these assets, we're trading option callers. So we sell call options for income, and then we buy put options for downside protection. And the trading schedule is 100 shares of the SPY Monday, Wednesday, Friday, 200 shares of emerging markets on Tuesday, 200 shares of the TLT and GDX ETFs on Thursday. TLTs are 20-plus year treasury. We're really not trying to get the yield from those bonds. We're really playing the change of interest rates when we invest in the TLT. And that's much easier to predict than really anything else. And then meanwhile, we have gold with spot gold near 1,500 an ounce. Gold miners benefit from these very elevated prices. And we're in a period of massive central bank easing, money printing. So as that money slowly escapes from different asset classes, we'll see it find its way down into hard goods like gold, commodity, and other assets. Okay, so the target income is $750 a month per $75,000 invested, or a 1% return. This is normally attractive to wealthier investors. And we have quite a few who are trading this on the go from their phone with 7-figure portfolios. So it's designed to be passive, very easy to follow, and atomic bomb proof. If you hate losing money, this is the program for you. Our average return is 1.35% per month. We've only had one losing month in 12 months, and that month was a negative 1% return. Over a 90-day stretch, we've never lost investors' money. And I will always play it safe and precautious versus trying to be hopeful and go for an outlandish gain. Now, most important is I want to point out that we make money when stocks go down. December, huge crash, we made 1%. May, big crash, we made 2.2%. In August, we were completely blindsided. I was expecting tariffs in July and positioned us for that, which is the only month we did lose. And then in August, we got surprised with trade war tariffs, and we picked up a 0.8% return. Now, David is saying, do you have aggressive systems with higher returns? Well, first of all, if you're going to make more than 15% a year, you're definitely very aggressive. But my note to you would be to take advantage of the leverage your broker will give you, because you can get 2 to 1 at extremely low interest rates right now because Fed policy has pushed rates so low. So take advantage of that. You could have a maximum drawdown of 2% and a return of 30% a year if you're taking advantage of the loans that all broker dealers will give you. So they'll give you 2 to 1 margin at a very low interest rate. So certainly that's the best way to get bigger results, David, without increasing your risk to reward ratio. Okay, so simple 4 ETF portfolio is extremely diversified and all you'll need for your retirement. The SPY ETF is the top 500 US companies. The Emerging Markets ETF is 1,000 companies in Asia and covers really the full gambit. So between those two ETFs, you own just about every important company in the world. Now, we're missing out on Japanese companies with this, and we're missing out on some big banks in Europe. But outside of that, and also those two markets are extremely in debt relative to everyone else. So these are really the best stocks you want to own in the world just with the SPY and Emerging Markets ETF. It's definitely a better stock portfolio than anyone listening to this video has currently. Meanwhile, the TLT is a missing piece of 99% of all investors I speak to. You have no downside protection. You have no bond exposure. Now, I have seen a lot of you guys do have some gold in your portfolios, but I found that you're buying tiny mining companies that probably won't ever make a buck. And so if you really do want to, David, Dean will get a hold of you. He can talk about pricing. And we also have a boot camp coming up in 2 hours. If you're interested in shorting China's currency for once in a lifetime opportunity, you might want to get on board right now. GDX is a better way to play gold than spot gold. Spot gold is probably going to have a hard time getting much above 1,500 because central banks are just printing money and buying it up as fast as they can, primarily China and Russia. But all these emerging markets who've seen their currencies devalue at rapid pace against the dollar, they're trying to build credibility for their currency by loading up on gold. So we may see a pretty good resistance line on spot gold around 1,500, but that's great news for gold miners if you have the biggest gold miners who actually have access to capital and can get the gold out of the ground in time to sell it. It's a very tough business, and most of these gold miners just lose money left and right. Again, our goal is to generate income and safety, not growth or speculation. You can simplify your holdings, reduce your risk, get better results with less work, and weatherproof your retirement portfolio. And we have a deal that ends tomorrow, 40% off our annual package, plus you'll get 1 month free in our $10,000 boot camp. Today we have a great presentation about the disaster China has created and how you can benefit from them having to deleverage their economy over the next several years. Here's a look at our disclaimer. Feel free to pause it and visit the link. Let's look at the top news. Now, there's not a whole lot of news out today, but let's take a look at the most important news. Trump doesn't want to drop the tariffs, and China wants them to go away without any real compromises. China wants us to just forget about this trade war altogether. I think they're just trying to draw this out as long as they can on both sides, and that we probably are not going to get a phase one deal. We've heard Trump just within the last hour say that we're a short pass away. I guess he likes to watch football. Larry Kudlow's more of a golfer. He says we're a short stroke. So they've been saying this for years now. This is a great list of risks to the market from Deutsche Bank. I really enjoyed reading this and agree with it. Okay, so top 20 risks for 2020: continued increase in wealth inequality, income inequality, and health care inequality. And the risk is that you get enough poor people pissed off, they overthrow the government and put someone in there that will change the system and redistribute wealth. This could be detrimental for markets, and maybe not this election, but I think in the next several elections, even the U.S. is at high risk of a game changer in leadership. 2, phase one trade deal remains unsigned. Continued uncertainty about what comes after phase one. So we'll see how long they can drag this out and how patient the market will be for a trade deal. 3, trade war uncertainty continues to weigh on corporate CAPEX decisions. So companies are not making moves to spend money, they're just buying back their own stocks. But because of the uncertainty in the market, they're able to borrow for dirt cheap or even for free in some cases. Microsoft can do negative yielding bonds in Europe and get paid to borrow money and turn around and buy their own stock back. Trade war. 4, ongoing slow growth in Europe and Asia, triggering significant US dollar appreciation. Our boot camp presentation is all about this, and this is not a new thing. This has been going on. I'm going to pull up every major currency there is and show it against the dollar, and you'll see that most countries who have US denominated debt, those debts have become relatively 2 to 5 times more expensive because of their currency losing value against the dollar. It's a huge problem. 5, impeachment uncertainty and possible government shutdown. That seems less likely to pass in the Senate, and it looks like they have passed some bills already for the government to stay funded. U.S. election uncertainty, implications for taxes, regulation. So Bloomberg did his first speech, and it was definitely lackluster. Elizabeth Warren still seems to be the candidate to be on the Democratic side, and she would be an absolute disaster for stock market. So we got to keep a close eye on that, certainly. 7, antitrust, privacy, and tech regulation. By owning the SPY, that does help us take away a lot of business risk. So a lot of you guys, I've noticed, will own big positions in tiny companies, mid-cap companies, or even large-cap companies, but they're not at the size of your Microsoft, your Apple, your Amazon, your Google. So the SPY ETF is a great way to reduce your risk to a certain company getting regulated or having any kind of downside risk to your portfolio. 8, foreigners lose appetite for U.S. credit and U.S. treasuries following the presidential election. Not sure about that one. I think the Fed is really trapped, pushing rates towards zero. Otherwise, the bond market will revolt on itself. 9, modern monetary theory style fiscal expansion boosts growth significantly in the U.S. and or Europe. So we're already doing that to a degree. We have massive deficits. The JP Morgan's buying up 25% of all government debt right now. And then the Fed's buying it from JP Morgan within a week later. So it's a complete crock, and that's essentially the same thing as MMT. U.S. government debt levels begin to matter for long rates. I think they will at some point, but perhaps not till we get to the effective lower bound. The Fed can certainly manipulate the bond market until it gets near zero. And yesterday in our boot camp, we went through the latest FOMC minutes. All they're talking about is how to deal with this crisis ahead. They're not talking about raising rates whatsoever. They're not talking about inflation problems. No, all they're talking about is what are we going to do when we get to the zero bound on rates. And so they've got all kinds of socialist-style strategies to keep the bond market together. Once bond investors realize we're at zero, the risk is, why hold it any longer? There's no more appreciation in the bond, and the yield is worthless. So that could cause a massive sell-off in the bond market, and probably the biggest market risk there is in the next several years. 11, the mismatch between the demand and supply in T-bills, another repo rate spike. So repo is still double subscribed. There's certainly something wrong with the banking system. Someone's lost a lot of money. I'm going to guess it's primarily smaller emerging market countries or a handful of banks that we've identified. So I watch those daily for signs of weakness. Also keeping a close eye on the lower rated bonds. The triple C's have spiked recently, and so there's a lot of risk. In fact, there we go. Fed reluctant to cut rates in the election year. I doubt that. They've been saying that after every rate cut. And then what do we get? Another rate cut. 13, credit conditions tighten with no more difference in CCC and triple B corporate credit. So triple C's have been spiking recently. So that's certainly alarming. Fallen angels, more companies falling into triple B and out of triple B into high yield. That's Jeffrey Gundlach's call for quite some time, is that the triple B is misrated, it should be downgraded, and that could cause your LQD ETF to sell off. And that's what we judge to determine if companies like Microsoft and Apple have cheap credit, which they're using to do corporate buybacks. 16, more negative yielding debt sends global investors on renewed hunt for yield in U.S. credit. So again, they're worried that people call the bottom in the emerging market debt markets and cause the same sort of sell-off we're worried about in the U.S. credit markets. Declining corporate profits means fewer dollars available for buybacks. Shrinking global auto industry, a risk for global markets and the economy. And house price crash in Australia, Canada, and Sweden. Well, how about China? Add that to the list. We've got a 2-hour presentation just about these housing bubbles. And Brexit continues to drag on. All right, so those are some good risks. I think covers the majority of the biggest risks to the market. Here's a look at the short position on the VIX. It's at an all-time record high. When this snaps, the VIX could spike significantly. Our boot camp members have some long call options on this, which we'll most likely add to. Probably not this Friday, but maybe next Friday. We're also getting ready to short the Chinese currency. So the timing's been one of patience. Visualizing interest rates throughout history, the average is more like 5% over the last 200 years. This goes back to 1,350. So this goes back a long time ago. And you can see the cost of money has typically been much more expensive than it is now. And likely we're going to see a massive spike in inflation and rates over the next decade. That's Ray Dalio's biggest prediction, as well as Jeffrey Gundlach, who are both well known for predicting bond markets as their specialty. And the problem is when you give out money for free, people don't worry about actually generating a profit. They just go around trying to take over market share, and will do so at the cost of losing money because they know they can just continue to sell bonds to fund their business. And so we have companies like WeWork going from a $30 billion valuation to below 8 in a week when all of a sudden they lose access to their credit markets. We've got Uber losing billions of dollars a quarter. So it's just allowing a lot of malinvestment. All right, moving along, China, U.S. held a phone call today and discussed core matters for a continued phase 1 trade talk. What a joke. Now, Lighthizer was supposed to fly out to China from an invitation from the Chinese, but he declined. So that's not a good sign. Trump said that the phase 1 deal on October 11th, Trump said that a phase 1 deal was agreed on October 11th when the S&P 500 was at 2970. Today, U.S.-China agreed to continue phase 1 talks, and S&P 500 is almost 200 points higher. So what will be the fair value once the trade deal breaks down? Will we be closer to 280, 290 on the SPY? China urges the U.S. to have a clear picture of the situation and immediately prevent the bill from becoming a law, stop interfering with Hong Kong's affairs, and meddling with China's internal affairs. Hong Kong is going into a recession from the protests. They did a vote over the weekend that was overly in favor of democracy. China is desperate for dollars. They're pricing some bonds in U.S. dollars. California man accused of spying for China pleaded guilty. A little bit of good news, 172 U.S. poultry plants approved for exports to China. Dallas Federal Reserve President Robert Kaplan, policy is in the right place for now. We have a more normally shaped yield curve. Economy needs more than just monetary policy. Monetary policy is in the right place. Again, they say this after each. I do suspect they will pause on the rate cuts on December 11th and 12th coming up unless Trump escalates the trade war. So he has a good incentive to do that if he wants lower rates. Dallas Federal Reserve President Kaplan, fourth quarter is going to be weak. They're looking at sub 1% growth for Q4, but potential for 2% growth next year. Fed Powell says the U.S. economy's glass is more than half full. And we have a very odd situation where there's outflows in the S&P 500, yet we're going to new highs. And so the only explanation is that it's getting bid up dramatically right before the market opens from the futures market. So it's gapping open. There's no price discovery. The banks are just artificially jumping the SPY ETF to much higher highs. And my expectation is to make it easier to deal with the sell-off when the trade deal breaks. Now in emerging markets, we're having the opposite. Extraordinary money flows into emerging markets and it's going nowhere. So very odd. The main buyers of the U.S. stock market are banks like the Bank of Japan and these huge banks that just got bailed out from the Fed. They're selling off their treasuries to the Fed for huge profits, and now they're goosing the stock market higher. No price discovery, and typically when the market does gap from one level to another, eventually it comes back down through the trading day and does a real price discovery. You can see the credit market gaining as stocks are gaining. In this chart, we can actually see the European bond market has been growing faster than the U.S. credit market. And that's because companies like Microsoft are getting negative yielding bonds. They're getting paid to borrow money. A union representing Bloomberg journalists has demanded that the publication lift its ban on investigating Michael Bloomberg and other 2020 Democratic presidential candidates. Dear colleagues, by now you've seen yesterday's directive to not investigate Democratic presidential candidates. We are extremely alarmed by management's decision to silence the journalists we represent at Bloomberg Industry Group, as well as the unprecedented journalists at Bloomberg News. Elizabeth Warren, Michael Bloomberg may think he doesn't need people to win this election. He just needs bags of money. He's wrong. That's why I'm investing in meeting thousands of voters, taking over 85,000 selfies, and building a grassroots movement that will fight for big structural change. And she's impressing me more and more in terms of being able to rally up people. Bloomberg just spent more money in the first week for his campaign with ad buys than Elizabeth Warren has raised to date. But if you study elections, money cannot buy an election. Just look at how much money Hillary Clinton put in and was an utter failure. So he's only had one speech so far. It was very lackluster. I like his policies, to be honest. I just don't think it's going to fly with the majority of the Democrats. So we'll see if he gains any momentum. But at this point, it's still looking like Elizabeth Warren or Pete Buttigieg is leading the way right now. Odds for a Senate conviction are at 12%. And as far as the House filing impeachment docs, everyone's expecting next week that will happen. But those odds seem to be sliding. And the popularity for this impeachment seems to be dying down. Let's be clear, our government criminalizes too many things and sends too many people to jail. In a Warren administration, we will repeal the 1994 crime bill, legalize marijuana,
undo the legacy of the war on drugs, and end cash bail in private prisons.
Leader McConnell, month after month, Speaker Pelosi has stalled on USMCA. Lots of talk, but no action for American workers. The rich have assets, the poor have debt. College costs skyrocket 112% above the rate of inflation for the last 4 years. This is what happened when the government subsidizes industries. David Deans are one of our coaches and brings on board all new members. So he can answer all questions related to our program in great detail and make sure you get proper treatment when you join our program, or if you join our program. SPY ETF, we've predicted the 315 since about over a month ago, just after the phase 1 trade deal was announced. And sure enough, we've jumped up with a lot of gap openings and very little price discovery. Emerging markets we did well with, but it's been slowing down. It's not kept up with the SPY. And this is signaling pessimism around the trade deal, as well as the underlying economy of China, which is certainly in some trouble without a whole lot more capital flowing into China. GDX had a nice jump today. It's correlated to the TLT, except it needs the fear factor times 2 compared to the TLT. The big picture is that we have all the central banks lowering rates, printing up money at massive speed. In fact, the amount of money the U.S. has printed and added to its balance sheet in the last 2 months is a faster pace than QE1, QE2, QE3, or QE4. It's the fastest growth of the Fed's balance sheet in history in the last 2 months. They only do this when times are rough. They have never cut rates because times are good. They've never done quantitative easing because times are good. So they're selling this to the public as just an insurance policy, but you can look at their track record. As much bad press as the Fed gets, they've predicted every single recession, and they've done the same action leading into it. They've cut rates. What did we just do? We cut rates 3 times this year. So I love gold. I love gold miners better I believe this will blow past that 66 level as we continue this path. LQD is the best way to measure if corporations will continue doing stock buybacks. When it's at this high level, they can get capital for nearly free, at least if you're one of the top dogs like Apple, Microsoft, etc. So we keep a close eye on LQD to be able to predict when there could be a long-term pullback in stocks. This needs to crash much lower for rates to get expensive and for corporations to stop borrowing money to buy back their own stocks. HYG has some exposure to those triple C, the worst of the worst bonds out there. And so it's still hanging in there. This one hasn't crashed. It's certainly not as healthy as LQD, but this is your junk bond ETF. So a big worry is that a lot of the bonds in the LQD ETF, which is priced for perfection, would be downgraded and moved into this bond, which would cause it to crash because the yields on those are much, much, much lower than the yields in HYG. So these are two great ETFs to watch if you want to predict the health of the credit market and the health of the stock market, because we know corporate buybacks represent most of the buying volume. Meanwhile, this is Stanley Druckenmiller's favorite indicator for the health of the stock market, the Russell 2000. You can see it's on the verge of getting past this little channel it's been stuck in. If it could break past 173, who knows how high the stock market could go. That would cause credit to get much cheaper for the middle of the companies, the mid and small sized companies, who are currently having to pay a lot more interest. They have such an unfair advantage against your giant multinational corporations. All right, guys, here's the chart that you want to pay attention to. This is CNY. I actually use CNH, the offshore one, but they're basically the same thing. This is devalued over the last several decades from 2 to 7. If you were trading that in the futures market, you would have made millions and millions and millions of dollars. It's extremely lucrative to predict changes of price of currencies. My expectation is that this can devalue over the next several years towards 14. It's a huge move, and when you see the underlying fundamentals of what China has done, you'll see why they really have no choice but to let this slowly slip and try to deleverage their economy. So that's coming up in our boot camp shortly. Gold, again, central banks are buying gold to boost the credibility of their currencies, which are quickly losing value against the dollar. This may create a ceiling on gold, but that's perfectly fine if you own the gold miners. Oil is starting to heat up in terms of price, and this can become a concern for our TLT because it does push inflation fears, although this is very bullish sign for stocks currently. And the best measurement for predicting the actions of the Fed is to look at what's going on in the 30-year German Bund. And so this is a huge trading partner of China. China's slowdown is affecting everyone, especially in Asia and Europe. And so we can see this downward sloping yield on the 30-year. My expectation is this is going to sub-zero, back into negative rates as the trade war escalates. And even if it doesn't escalate, as long as China decides to deleverage its economy rather than expand its debt, it's going to be detrimental for Germany's government. And so most of the stimulus in Germany is not real business activity. It's just the government printing money and trying to boost its numbers. Now, the U.S. 30-year yield follows a similar path, but note it's much less downward sloped. And that's why we continue to see money just flood its way into U.S. products, despite the world clearly being in a global slowdown right now. And this is all shown in the dollar, which could potentially travel as high as it did in the dot-com bubble. And again, if you just go look at any currency around the world, almost all of them are severely devalued against the dollar, especially over the last 5 to 10 years. So this problem is just continuing to build upon itself because their dollar-denominated debts become more and more expensive to pay in their own currency. And that's the debt vehicle everyone's chosen to use is the dollar because it's the most stable store of value. Meanwhile, if you're a Bitcoin fan, we're still long Bitcoin and Ethereum. It's a tiny part of our portfolio. But when you have governments trying to restrict capital flows, like in China, that pushes more people to want to get out of the currency. So they've done a crackdown in the last week on Chinese trying to get their money out of CNH. And so this caused a little short-term volatility. But the big picture for Bitcoin and Ethereum has never been better, and this currently represents 2% of our total portfolio. And we don't let it go above 2%. As it does appreciate, we're pulling off profits. And when it goes below 2%, we're adding to that position. So 2% total risk in Bitcoin and Ethereum on top of the 8% in GDX can add a lot of value to your portfolio when you realize the big picture. And that's, we're sitting on $266 trillion of debt that's ready to burst. All right, guys, that's into the presentation today. Do call Dean if you'd like to get into our boot camp today. 505-322-7515. We're going to give you 1 month free in our boot camp, our options trading boot camp that has some exclusive trades, not part of our normal advisory. They're more advanced. We're playing the futures market and Forex market to take advantage of a situation in Hong Kong and China. We're also doing some special trades on the VIX. So it's higher risk, higher reward trading that are offered in our boot camp. And so that helps add on to what you're already doing with your ultra conservative, safe strategy with the bulk of our portfolio, doing the daily income trades. All right, that's a wrap. Thank you guys so much for your time. And tomorrow we'll close out our SPY trade. Wednesday, we're not going to write a trade that expires on Friday. It'll cover through Monday. And because of Thanksgiving, we'll be closing out the TLT and GDX on Friday. So thank you so much for your time. We really appreciate it. And until tomorrow.